Well, hi everybody and welcome. I'm Mike Warner, and today we're going to be talking about accounting for receivables and bad debt expense. And I think you'll agree by the end of the video that accounting for bad debt expense is really the star of the show here today. So let's go ahead and get started with receivables classifications. And we'll begin with two very popular ones, accounts receivable and notes receivable. And you might wonder, what's the difference between these two? Well, accounts receivable are receivables that have to do with charge accounts. That is, they're for charge accounts that we create to sell goods and services to our customers. Whereas notes receivable occur when we make a more formal loan to another entity, and we have that other entity sign what's called a promissory note. So if the customer signs or the borrower signs a promissory note, if a promissory note exists, then it's going to be a notes receivable. If it's a charge to a customer on a charge account, it will be an accounts receivable. So those are the basic differences. Now, there are trade receivables and non-trade receivables. Trade receivables have to do with, receivables created in the normal scope of our business. That's through the sale of goods and services to our customers. Non-trade receivables would be everything else, such as loans to employees, loans to shareholders, loans to others. And then there's another consideration, which is, are the loans current or non-current? Well, current receivables will be collected, or at least they're expected to be collected within the longer of 1 year or the current operating cycle. And non-current receivables will be collected after the longer of 1 year or the current operating cycle. And you may wonder, what is the operating cycle? Yeah, I mentioned it, but what is it? Well, sometimes it's referred to cash to cash. And it's the time that it takes, time that passes between investing in goods and services that we provide to our customers and when the company collects the payment for those goods and services. So we might first invest in the product by purchasing it and paying cash for it, and then we might sell it on account, and then we'll collect that accounts receivable, and then we will then have cash, of course. So that's the cash to cash cycle. Now, for most companies like Walmart, the cash-to-cash cycle is real quick. It's very quick. Oh, yeah. From the time they invest in their product to the time they collect the money for that product is pretty soon. They invest in the product, they bring it into their warehouse, they may pay for it, and then they sell it almost immediately in their stores. But for other businesses, such as a pineapple plantation, when you plant pineapples, it takes 2 years before you can harvest the pineapples on average. Christmas trees, from the time you plant Christmas trees to the time you harvest them, is about 5 years. Tabasco sauce, believe it or not, it takes 3 years to make Tabasco sauce because they mix all the ingredients together and then they put it in a wooden cask to ferment for 3 years. And then, of course, the various whiskeys. Jack Daniel's whiskey is a minimum of 4 years. Chivas Regal, a minimum of 12 years. I mean, they have like 18-year, and longer, operating cycles. So let's go ahead and continue on here with some other examples of receivables. You've got advances to employees or loans to employees, employee loan receivables. You have advances to corporate officers for one reason or another, loan to corporate officers or corporate officers loan receivable. You have deposits receivable for utilities and other things. For example, if you start if you open up a new location and you go to get the electricity, it may be that your utility company will demand a deposit. And now after you pay the electricity on time for like 5 years, they'll give you that money back. So in the meantime, you have a deposit receivable. Dividends receivable, if we have some dividends that we're expecting from one of our equity investments that we have. Interest receivable, this is quite popular. When we, very common, is very common. If we make a loan to another entity that's an interest-bearing loan, interest will build up over time. So if there's any interest that has built up, or what we call in accounting accrued, any interest that has accrued, but we haven't received it yet, we would go ahead and record it as an interest receivable. You also have tax refunds receivable if you have overpaid your taxes. And there's some other miscellaneous receivables, such as claims against shipping companies for damaged freight, or insurance companies for losses that we have submitted a claim for, or maybe we overpaid our premium and they owe us these funds back. And then maybe suppliers for returns and damaged goods, or even perhaps just allowances that they're affording us on the goods that we have purchased. Now, brings us to the next area, which is sort of one of the bad things about doing business on credit, and that is bad debt. Whenever you're selling goods on credit, there are some customers that will not pay you. We're hoping everybody will pay and that you'll get all of your funds back. But as you know, when you've issued credit for, hundreds of thousands of dollars or millions of dollars, the law of averages indicates that we're not going to get all of that money back. So the question becomes, how to do the accounting for this bad debt? And there are two methods. One is called the direct write-off method, and the other one is called the allowance method. And we need to take a look at both of these, because if you're in an accounting class and you're covering bad debt, they're going to be requiring that that instructor is going to require that you know about both of these methods. So let's first go into the direct write-off method and see how that works. So what we have here is an example that we're going to use time and time again for every one of these bad debt examples. It's a situation where we have a sale of $4,000, and we make that sale on December 4th of 2023. And we just go ahead and record the sale, and then later we'll find that amount becomes uncollectible. So let's first go ahead and record the sale. This is in 2023, so let me note that 2023, and it's December 4th. And so now let's go ahead and record the accounts receivable. For $4,000, and we're going to credit sales for $4,000, or if you like, you can call it sales revenue. Sales revenue. There we go. Now, time marches on, and we're trying to collect this money, trying to collect the money, and lo and behold. After months of trying, these funds were due, say, in 30 days, and after months and months of trying, we discovered that the company we're trying to collect from has gone out of business. They're no longer even in existence, and so we're never going to get this money. So what we have to do is write it off. And what it means to write something off is that you are removing it from your books. So let's go ahead and write this off. And what we're going to do using the direct method, we discover it's uncollectible on April 4th, 2024, which is the next year after the sale. So let's go ahead and make the entry for 2024, excuse me, on April 4th. And what we're going to do is we're going to directly debit bad debt expense when we make the write-off. So we're going to debit bad debt expense for the 4,000. And we're going to credit accounts receivable. For the 4,000. There we go. And so we've written it off, and everything seems fine, right? I mean, everything's good. But actually, there are some issues here. There are some issues, and let me talk about those issues just for a moment. And let's take a look at this slide, which is the same entries. You'll notice these are the same entries, but I typed them out in this slide instead of handwriting them. So there they are. And when it comes to the direct write-off method, the difficulties are that the sale was made in 2023, 1 year, but the write-off happened in 2024. And as we indicate down here, this results in a poor revenue and expense matching, in that the sale, the revenue is recorded in 2023, and the bad debt expense, the expense associated with the sale, is recorded in 2024. And there's another problem with it too. I mean, the accounts receivable that we showed on our balance sheet, which included the $4,000, it included an amount we were never going to get. So it actually, it overstates our 2023 accounts receivable by the $4,000 because we're never going to get those funds. So this method of recording bad debt expense, I mean, it works, but it has some theoretical issues. And because of that, it is not permitted for GAAP. And you might want to make a note of this. Let me slide this up a little bit here. The direct write-off GAAP, maybe I should say U.S. GAAP, does not permit the direct write-off method. And now, if your accounts receivable and your write-offs are tiny, then you can get away with it. But if you have significant accounts receivable and bad debt, you can't use the direct write-off method. Now, for tax purposes, for the U.S. IRS, the Internal Revenue Service, requires the use of the direct write-off method. So it's not good for financial reporting, not good for our financial statements, but when we do our taxes, we've got to use this direct write-off method. So it's well worth knowing something about the direct write-off method for that reason, because it's used for taxes. And also, if you become involved in a company that has very, very minimal, tiny bad debt expense, you can go ahead and get away with the direct write-off method because it will not create a material misstatement in your financial results. But certainly, U.S. GAAP doesn't officially approve it, and you should use the allowance method. So what's the allowance method all about? The allowance method. Well, under the allowance method, because it is impossible to know which receivables will be uncollectible, like that $4,000 sale, we did not know it was going to be uncollectible when we made the sale. Otherwise, we wouldn't have, charged that on a charge account. We just wouldn't have made the sale. So we didn't know it was going to be uncollectible when we made the sale, but it turns out it was. So we had no way of knowing. It's impossible to know which sales are going to be uncollectible. And therefore, what happens is we just take a look at the whole situation and create an allowance based on the amount of bad debt the company expects for the estimated uncollectible amounts. So that's what we're going to do. That's what the allowance method is all about. We don't know which ones will not pay. We don't know which accounts won't pay, but we can go ahead and create an allowance, estimating, on average, how much will be uncollectible. Now, as we do this, we've got to estimate the uncollectible accounts. We've got to estimate the uncollectible accounts. And as it turns out, we should be looking at accounts receivable and not so much at sales. I just want to throw this in at the beginning because years ago, companies would either use a percentage of their sales on account to estimate their bad debt, or use a percentage of their accounts receivable to estimate their bad debt. But nowadays, after this ASU, Accounting Standards Update 2016-13, which specifies, in somewhat a pretty high level of detail how to estimate, your losses for bad debt and such things, it indicates that you really need to look at the accounts receivable instead of looking at or trying to estimate it based on amount of sales. So if you look at a textbook like Intermediate Accounting by Keeson-Wygant in the 18th edition, and this is different than it would be in prior editions. Like if you look at the 15th edition, it doesn't say this, but because it was before this 2016 pronouncement came out. But if you look at Keeson-Wygant, chapter 18th edition, chapter 6, it says, in general, estimating bad debt expense with a focus on the income statement, i.e. a percentage of sales, is not appropriate. Okay? And so I will show how to do this at the very end of this presentation today, just in case you're in a course that is requiring that you cover this. Maybe you're using an older textbook or perhaps one that was not updated for this pronouncement. Maybe your instructor likes it. So I'll show that, but I'm certainly not going to focus on that method. So let's go ahead and take a look at some methods that are acceptable. And the first one is a focus on the accounts receivable. So it's the allowance method, which is the percentage of accounts receivable. And this first one here, I'm going to use what's called an accounts receivable aging report. Now, this aging report would actually be many, many, many pages long. It would be quite long, quite lengthy, and list all of our accounts, and it would separate them by how many days outstanding they are. And then at the bottom of the report, all these would be totaled. And you see here that we have a total accounts receivable of $110,000. And of that $110,000, $80,000 is only, 30 days old or less. So it's between 0 to 30 days old. And then we have some other customers, let's say that our terms are net 30 days, so the customers are supposed to pay us in 30 days. We've got some customers, and not too many, but some have not paid us within the 30 days, and instead the age of those receivables is between 31 and 60 days. And then we have some that are really problematic customers that have waited over 60 days to pay their bills. And then finally out here, we have some really troublesome customers that their balance is over 90 days old and they have yet to pay us. Now, if we think about it, the amount of this 90-day-old accounts receivable, the amount we're going to collect, it's pretty likely that we won't get a lot of this. That we'll, hound these customers, and if they let it go 90 days, they may just never pay us. So what we see here is we've estimated that 55% of the accounts that are over 90 days old will not pay us. So if we multiply that out, and you might want to get out your calculator to do this along with me. Why? Because if you're watching this just for entertainment, I can't imagine that. I can't imagine that. But if you are, then you can just watch and you're good. But if you're watching this to sort of supplement your studies or really learn about this, it's better if you get out your calculator and do the calculations along with me, so that you get that hands-on experience, and therefore you're much more apt to remember what we're doing and learn it as opposed to just looking at it and forgetting it. So if we take $5,000 times 55%, what we get is $2,750. $2,750. So of this $5,000, we think $2,750 is uncollectible. And then of the $10,000, there's quite a bit of this that we're not going to receive too. We estimate we're not going to get 20% of that. So 20% of 10,000, you can just do this in your head, I'm sure. It's $2,000. And we have this 15,000, and of that, it's a lot better. We're going to get most of this. It's just some of the customers just mailed the check late or whatever, so we're going to get most of it. But about 3% of this we estimate will be uncollectible, and 3% of 15,000 is $450. And then of the 80,000, we think we're going to get most all of that. Maybe 1% will be uncollectible, which would be just $800. And then if we add these all up here, add them all up, the 2,750, the 2,000, the 450, and the 800, let's add them up. And what we will get, we'll put the total here, is $6,000. $6,000. So of this $110,000 of accounts receivable, we think that we estimate 6,000 will be uncollectible. So now let's go back up here and look at some of this data for the company. Their 2023 sales on account were $1,200,000. Their accounts receivable balance is $110,000, as we see here. And the allowance for doubtful accounts, before we do anything, is $2,000. So what happens when we record the bad debt expense? We don't debit bad debt expense and credit the accounts receivable, because we don't know which customers will not pay us. So instead, we use this contra account. And a contra account, as you probably know, is an account that's grouped with other accounts, like this one's grouped with accounts receivable, but reduces the balance of those accounts. So we're going to use this allowance for doubtful accounts, a technical account title here, you should know, to record our bad debt expense and put the allowance in here. Now this account begins with a credit balance of $2,000. And I'm going to go ahead and put that into T account, $2,000. There it is at credit balance. The accounts receivable, let me go ahead and put that here, $110,000. And the idea is, on the balance sheet, we want to show the amount that we're really probably going to collect. And so what we need to do is boost this allowance from the $2,000 to, let me go ahead and fill it in here, to an ending balance of $6,000. We want an ending balance of $6,000. That's what we need in this account. And then if we take the $6,000 minus the $110,000 minus the $6,000, that's going to give us what? $114,000 that we think we will be collecting, right? So that's how much we think we'll collect. So let's go ahead. No, that's not 140. 104,000. 110 minus 6 gives us 104,000. What am I doing? Let me fix this. Sorry about that. $104,000 that we think we can collect. Not the whole 110, but we think we'll be unable to collect 6,000. So we have this. We want the balance in this account to be $6,000, the uncollectible account, the allowance for doubtful accounts. And so the amount that we put on the balance sheet will be this net amount, which is $104,000. So when you see on your balance sheet, on a balance sheet you're looking at, it says accounts receivable, comma, net, it means net of this bad debt. Now the thing is, it's at $2,000 now. We want an ending balance of $6,000. What do we need to do to this account to make it happen? What do we need to do? Debit it or credit it? Well, obviously, we need to credit it and to go from $2,000 up to $6,000. Let's see, $6,000 minus 2. We need what's the entry need to be? $4,000. $4,000. A $4,000 credit to the account. So what we'll do in 2023, and this would be an adjusting entry that we're probably going to make on December 31st, an adjusting entry at year end. We're going to debit bad debt expense for the $4,000 and credit the allowance for doubtful accounts abbreviating a little bit just to save some time, of $4,000. And there is our entry. Now notice that the calculations we did down here, giving us the $6,000, does not give us the amount of the entry. It gives us the amount of the ending balance in the allowance account. And then what we got to do is look at the beginning balance we have before any adjustments and make an entry that brings the account balance up to the $6,000. So it's a pretty easy thing to do as long as you pretty much follow the theory of what's going on here. Now, some companies, instead of using an accounts receivable aging, and your instructors may do this as well, because the aging is kind of hard to put on the board, and you got to write it all down and so forth. And companies got to calculate it all. What will happen is companies will look at their history of uncollectible accounts, and they'll come up with a notion that in a given year, their uncollectible accounts run about 8%, 5%, 4%, whatever it is. In this case, the company's estimating that their uncollectible accounts are 9% of the entire accounts receivable balance here. So if we take that accounts receivable balance, the accounts receivable balance of $110,000 times the 9% percentage uncollectible, we get what do we get? $9,900, right? Is that right? You know what? Let me change. That seems too high to me. If you don't mind, let me change this to 7%. 7%. It just seems way too high for this little thing. Sorry about that. Sorry, guys. So at 7%, sorry, easy fix though, right? 7%, that would be times 110,000. Go ahead and do the math. And I think the math that you just did would come out with an amount of $7,700. $7,700. Now remember, this is not the amount of the entry. That's not the amount of the entry. So this is the amount that we think we will not collect, and instead it's the ending balance for our allowance for doubtful accounts. So we want to go ahead and move it down here. That's how much it is, $7,700. Now the thing is, and let's go ahead and fill in some of these other balances. We've got a balance of accounts receivable of $110,000. And we have the allowance for doubtful accounts has a credit balance. Credit says credit here of $2,000. So let's go ahead and put that in here, $2,000. And if this allowance for doubtful accounts starts off with a balance of $2,000, and we need to end up with a balance of $7,700, what's the amount of our entry? I pause for effect and to have you guys calculate it. Yes, I think most of you would say it takes another $5,700 put into this account. So this is the amount of our entry here, backed into our entry, to bring this account up to the balance it should be. Now the numbers are a little different for this example versus the other one because we assumed they used an accounts receivable aging before, and in this example, they're just using this 1% for the whole, the whole accounts receivable. So with this in mind, let's go ahead and calculate the. Let's see, how much is the accounts receivable balance? Then would be $110,000 minus $7,700. Gives us $102,300 that will appear on our balance sheet. Oops. Yeah, $102,300. That's what's going to go on our balance sheet. So we're going to take the accounts receivable account, and then the allowance for doubtful accounts, this contra account, to determine the accounts receivable net that appears on our balance sheet. We have one more thing to do here, and that is to make our entry. So this is going to be made in 2023. It's December 31st. It's going to be an adjusting entry. We do this once we're at year end. We're sort of scoping things out, making the various adjusting entries that we do. And so what we'll do is debit bad debt expense for the $5,700. Sorry about that. And we're going to credit the allowance for doubtful accounts. Abbreviating just a little bit for the sake of time, $5,700. And there we go. So we've made our entry. This is a very common entry on exams that cover this area, where they'll give you the sales on account, the accounts receivable balance. They'll give you the balance in the allowance for doubtful accounts account, and then they'll give you the percentage of estimated uncollectible accounts, and then you've got to use that percentage, multiply it by the accounts receivable balance, and that will not give you the amount of the entry. This is critical. You can't go making an entry for this amount or else it will be wrong. Instead, I would recommend, creating a T account, if you know about T accounts, and putting the beginning balance in the T account. Use the $7,700 as your ending balance, and the difference is the amount of your entry. If you don't know too much about T accounts, you can just say, okay, my beginning balance, the balance I need is $7,700. The balance that's in the account already is $2,000 in the same direction. Therefore, I need an entry for $5,700. And you make that entry, and you take it to bad debt expense, and you credit the allowance for doubtful accounts, and you are good to go. You're golden. You're going to get that question correct. Now, what would happen? I'm going to take the same example, and I'm going to change this. I'm going to change this right here. Change this so that it's a debit balance of $1,000. Okay, and to make it a little neater, let's go to another sheet. So here we go, the same deal, but this time you notice we have a debit balance in the allowance account, and it's only $1,000, $1,000 debit. So instead of it being a credit over here, it's a debit over here on this side, on the debit side. And of course, we still have the same $110,000 in the accounts receivable. And let's go ahead and change this again to the 7%, 7% instead of 9%. I think it's more reasonable. And here we go. So this is the situation. And you may say, well, how in the world would the allowance for doubtful accounts account have a debit balance in it? Well, as it turns out, if we underestimate the bad debt expense, and we write off more than our estimate, it's going to put this account into a debit situation. And so you could have a debit balance or a credit balance. Who knows what you're going to have? But the reason we're covering this is so that you won't even care. You'll be able to handle it either way. No problem. So let's get started. We're going to take our accounts receivable, $110,000. We're going to multiply it by the 7%, and we get our ending balance of $7,700. No difference here. No difference at all. And that's the ending balance we need in this account. So here we go. Let's put it down here. Good deal. $7,700. There we are. $7,700. And now we need to figure out how much of an entry it will take. So it's going to take an entry. Oh, I can do the math in my head real easy. It's only going to take $6,700. Oh wait, no. If I do 6,700, and then I've got a debit over here of 1,000, that means this. I need an amount of an entry that will take this account from a debit balance and switch it over to a credit balance of 7,700. So I need not only the full 7,700, but I need an extra 1,000 to get rid of this debit balance over here. So I'm going to actually need an entry of $8,700. $8,700 to switch that balance from a debit balance of $1,000 to a credit balance of $7,700. And then, of course, my accounts receivable that I'm going to show on my balance sheet's the same amount, $102,300. That's the accounts receivable net. And now I can go ahead and make the entry. 2023, December 31st. Bad debt expense. For the $8,700, and credit the allowance for doubtful accounts abbreviating just to get quicker here, move things along, 8,700, and we're good. Now, the complication with this, the hard part, is right here, making sure that you properly consider the debit balance in the account so that you calculate the right amount of the entry, which in this case is $8,700. So if it's a credit balance, in the account, you're going to take your $7,700 and reduce it by the credit balance. If it's a debit balance in the account, you're going to take your $7,700 and increase the amount of the entry by, the balance in the account. So that's the amount of our entry. So right now, if we were in a classroom, I'd be saying, hey, any questions about this? And I'm sure we would have a question or two, but I'm hoping that I was able to sort of keep this thing moving and, answer your questions by just doing the presentation in a pretty wordy fashion. So the next thing we got to do, now that we've got the allowance set up, went through year end, everything was great. The next year, lo and behold, remember on April 4th, we determined that this $4,000 sale that we talked about earlier in the presentation, this $4,000 sale is going to be uncollectible. We are never going to get that money. And so on April 4th of 2024, we go ahead and we record the write-off to remove it from our books because we're never going to get it. So in 2024, we've got to write it off. So this is April 4th, the date we determine it's uncollectible. And surely what we're going to do is to remove it from accounts receivable with a credit. We're going to credit accounts receivable for the $4,000. And that's going to remove it from our accounts receivable because, as you know, accounts receivable has a debit balance normally. So we're going to remove it from accounts receivable. And then the question becomes, what should we debit? And some of you might be saying, oh, debit to bad debt expense. Oh, no, we don't want to do that. We don't want to do that because we've already debited bad debt expense back here when we created this allowance. And if we debit bad debt expense again, it's going to be doubling up on the expense. So instead, we use the allowance account and we debit the allowance for doubtful accounts. For the $4,000. And that's how we write off the accounts receivable. Now, as you can see here, we're debiting the allowance for doubtful accounts when we make a write-off. If we have various write-offs throughout the year that total a greater amount than the $7,700 that we put into that account, then it's gonna change the balance in that account from a credit account balance to a debit account balance. So it's possible that if you have a lot of write-offs, more than you anticipated, your balance in the allowance for doubtful accounts will become a debit balance. But again, that's not a big problem. We've learned how to handle it, and we should be good with that. Now, what happens if the customer finally pays? So let's say, lo and behold, August 8th of 2024, August 8/8/2024, a very nice day, nice date. The customer shows up and says, listen, I'm so sorry, we ran into some problems, we're unable to pay our bills for a while, but we want to pay now. Oh, we already wrote that off. We don't want the money. Oh, no, don't say that, don't say. Oh, thank you so much for making your payment. We really appreciate it. So they go ahead and give you the $4,000 amount, and so you are going to be debiting cash eventually. And now you know that you don't have an accounts receivable for this. You don't have an accounts receivable, and instead you put it in the allowance. So you might be thinking, well, what I'll do is just go ahead and take it to the allowance, and that would be a mistake, because if you do that, the accounts receivable account for this customer will not have a full record of what happened. So what you want to do, number one is to reestablish the accounts receivable, to reverse the write-off. So in 2024, August 8th, we're going to reverse the write-off by debiting accounts receivable abbreviating a little bit for the sake of time again, $4,000. And then we are going to credit the allowance for doubtful accounts. $4,000. That reestablishes the accounts receivable. So now this accounts receivable record is fairly complete. The only thing missing is the payment that we received. So let's go ahead and on 2024, again on August 8th, we're going to go ahead and debit cash for the $4,000, and we're going to credit accounts receivable for the $4,000. So the customer account is complete. We have the sale that's in the account. We've got the write-off. We've got the reversal of the write-off, and we have the collection. So in later years, we're going to show not only the first entry to reestablish the accounts receivable, but also the second entry, which is to record the cash coming in and the payment. So now that pretty much handles most of this accounting for bad debt. And so you should be pretty well versed at it, and depending on the course that you're in, you should be able to handle most of the things that come along. And I would say that at this point, if you're, say, in one of my classes, like Intermediate Accounting 1, I'd say you're done. You can go ahead and call it a day, and I would say, thank you, please like and subscribe if you like the video, and beg for you to do that, do that. But for others that are using other textbooks like Wild and Shaw's Introductory Accounting Textbook, they still have the percentage of sales method included, and you might have some homework for that method, and your instructor may even test you on that method. So I don't want to leave you guys in the dark. So now let's go ahead and take a look at the percentage of sales technique for establishing the bad debt expense for those of you who need it. And remember, this technique is no longer preferred under U.S. GAAP, but may still be included in some textbooks. So just for those of you who might still be seeing this, let's go ahead and take a quick look. It'll only take a couple of minutes. It's actually an easier technique to master than the percentage of accounts receivable. So let's get right to it. So here's the situation again. It's the same example that we've been dealing with all along. Here you've got the give me just a second. You've got the sale amount, sales on account, or $1,200,000. You've got the accounts receivable balance here of $110,000. You've got the credit balance in the allowance, $2,000. No problem. Just put those things in there. And now the estimated uncollectable accounts is half of 1% of sales this time. So let's go ahead and take a look at that. So sales are $1,200,000 times 0.005 for 1/2 of 1%. So it's $6,000. So if we take, since it's the percentage of sales technique, we're going to take our sales on account, $1,200,000, times this 0.5%, which gives us $6,000. And once we do that, that's the amount of the entry. So 2023, December 31st, we're going to debit bad debt expense. For the $6,000. we're going to credit the allowance for doubtful accounts. Writing fast and abbreviating a lot because I know you want to get done with this. 6,000, and we're done. So you notice under this technique, when we apply the percentage, it gives us the amount of the entry. Not the ending balance. So what we can do then is we can go ahead and put that entry in here, $6,000. That gives us an ending balance of $8,000, and therefore the amount that we're going to show on our balance sheet in this situation would be, the $102,000, which is the $110,000 minus $8,000. So I would say this is an easier technique because you just take the sales times the percentage. It gives you your entry, and you're pretty much done. Fewer complications than the percentage of accounts receivable technique. Now, what would happen if you had a balance in your allowance of $1,000? So in this case, we have $110,000 of accounts receivable. We have a debit balance of $1,000 in our allowance account. And the company looks at this situation and says, well, we think, based on prior experience, that 1% of our sales on account will be uncollectible. So let's take the $1,200,000 times the 0.05%. No, excuse me, that's not right. 0.5%, and that gives us the $6,000. That's the amount of our entry. That's the entry. So let's go ahead and make the entry. Same as before. 2023, December 31st. We're going to debit the bad debt expense for $6,000. Credit the allowance for doubtful accounts. $6,000, and we're done with our entries now. But if your instructor says, what's the net accounts receivable amount for the balance sheet, you'd go ahead and put this up here, 6,000. That's your entry, 6,000. So the ending balance in the account is only 5,000, right? The 1,000 debit and the 6,000 credit, so it's a balance of 5,000. So the net accounts receivable would be $105,000 in this situation. So there you go. Again, it's the percentage of sales technique. No longer a preferred method of doing this, but just in case you run into it, there it is. Now I want to say one more thing about this. It has to do with the write-offs. The write-offs, as you can see here, are done exactly the same way. So you do the same entries for the percent of accounts receivable and the percent of sales technique to do the write-off. You notice that we debited the allowance for doubtful accounts and we credited accounts receivable just like you see here. Now, what about this? What if we, just a second. What if we write it off and then the customer shows up later and wants to pay the full amount? No problem. We've already learned how to do that. What we're going to do is, number one, reestablish the receivable just like we did before. It's the same entries under the percentage of accounts receivable and the percentage of sales techniques. The entries are the same. So we reestablish the accounts receivable, and then step 2, we go ahead and record the receipt of cash. So that's how that works. So listen, everybody, I sure thank you for tuning in and putting up with my couple of mistakes I had in there along the way. I hope the rest of the video is okay. I thank you so much for being here. If you like this video, please, please, please give it a thumbs up. The channel is very tiny, so every little thumbs up counts a lot. And please consider subscribing to the channel. That also counts for quite a bit. So thank you so much. And from Miami, Florida, this is Mike Werner saying, have a great day. We'll see you next time. Bye-bye.